Washington, D.C. The United States inflation rate has been gradually declining over the summer after reaching 40-year highs. The Federal Reserve, though, doesn't appear too enthused and isn't persuaded that the battle against rising prices is close to being won. Stock markets fell on Thursday as investors began to realize that the Fed would be willing to let a recession if that's what it takes to get inflation back down to its target level of 2% annually. Investors were alarmed by Wall Street's growing awareness of how far the Fed appears willing to go to combat excessive inflation. The Fed's officials anticipated that they will increase its benchmark rate by a further 0.75 of a point, to a whopping 5% to 5.25%, and maintain it there through 2023 in updated predictions they released on Wednesday. Some Fed watchers had predicted only one more half-point increase in interest rates. These higher rates will result in greater borrowing costs for individuals and businesses, including those seeking mortgages, auto loans, and business loans. All of these indications suggested that the policymakers would be willing to accept a recession as the cost of containing inflation. According to Ryan Sweet, senior U.S. economist at Oxford Economics, the Fed's message was clear: we're going to break something. Either we'll stop the inflation, or the economy will collapse. The Fed may soon declare some progress in its fight against inflation, and may even change course and drop rates at some point in 2023, many investors had convinced themselves. The pressure on supply chains, which were previously overloaded with client orders and led to shortages, delays, and higher costs, has decreased as a result of the slowing economy. Oil prices have also fallen, lowering pump prices. According to AAA, the average price of a gallon of unleaded gasoline on Thursday was $3.19, down from $5.02 in mid-June. However, Fed Chair Jerome Powell was not in the mood to rejoice because he had been late to detect the inflation threat when it materialized in the spring of 2021. Powell essentially ignored the indications of slow but steady improvement. Unless inflation has drastically decreased by then, which Powell does not appear to predict, Powell appeared to bat down hopes that the Fed may wind up dropping rates by late next year, a move that generally acts like steroids for markets and the economy. The prediction for inflation for the following year was raised by the policymakers from what they had anticipated in September. It implied that they believed their efforts to combat inflation aren't having the desired effect. That change surprised a lot of economists. The Federal Reserve anticipates more rate increases, a weaker economy, and more unemployment than it predicted 3 months ago for the upcoming year. On Thursday, mounting concerns about a recession weren't just coming from the Federal. The European Central Bank, which is waging its own robust campaign against inflation, hinted that it too would raise interest rates beyond what markets anticipated, increasing the likelihood of a European collapse. The American government revealed on Thursday that consumers reduced their spending at stores in November. Considering we were in the middle of the holiday shopping season, that was alarming news. Additionally, the Federal Reserve Banks of Philadelphia and New York published depressing studies on manufacturing in their respective areas. Long-term Treasury bond yields decreased, indicating that potential recession worries among bond investors are mounting. The Federal Reserve is particularly concerned that a lack of workers in the labor-intensive services sector, which includes everything from hotels and restaurants to airlines and entertainment venues, could keep wage growth high and make inflation more intractable. The Fed may be exaggerating the strength of the inflation, according to Sweet of Oxford Economics. But he claimed to understand its plight. Powell and the other policymakers are concerned that failing to control rising inflation might result in stagflation, the worst-case scenario for a central bank, even if it causes a recession the next year. That trifecta of slow growth, huge unemployment, and ongoing inflation is the worst possible scenario. It's a challenge without an obvious answer. Reporting from New York was ____Cho. Christopher Ruggeber, an AP Economics writer, contributed to this article.